Welcome back to the MicroLearning Institute. In this tutorial we look at IAS 19 Employee Benefits. The objective of IAS 19 is to outline the accounting requirements for employee benefits, including short-term benefits, post-employment benefits, other long-term benefits, and termination benefits. IAS 19 establishes the principle that the cost of providing employee benefits should be recognized in the period in which the benefit is earned by the employee rather than when the benefit is paid or payable. Post-employment benefit plans are informal or formal arrangements where an entity provides post-employment benefits to one or more employees. Under IAS 19, the treatment for a post-employment benefit plan depends on the economic substance of the plan and results in the plan being classified as either a defined contribution plan or a defined benefit plan. Firstly, let's look at what IAS 19 says about defined contribution plans. With a defined contribution plan, the entity pays fixed contributions into a fund and has no obligation to make further payments if the fund does not have sufficient assets to pay all of the employee's entitlements to post-employment benefits. The treatment under IAS 19 for a defined contribution plan is the amount recognized in the period is the contribution payable in exchange for service rendered by employees during the period. Additionally, contributions to a defined contribution plan which are not expected to be wholly settled within 12 months after the end of the annual reporting period in which the employee renders the service are discounted to their present value. Secondly, let's look at what IAS 19 says about defined benefit plans. A defined benefit plan creates an obligation on the entity to provide agreed benefits to current and past employees and effectively places actuarial and investment risk on the entity. Let's look at some IAS 19 definitions. Firstly, the current service cost. This is the increase in the present value of a defined benefit obligation resulting from employee service in the current period. Essentially, the current service cost is the cost of the current service. In contrast, the past service cost is the change in the present value of the defined benefit obligation relating to employee service in prior periods. The return on plan assets relates to interest, dividends, and other income derived from the pension plan assets, as well as other gains or losses on the pension plan assets. Settlement refers to a transaction that eliminates all further legal or constructive obligations for part or all of the benefits provided under a defined benefit plan. Actuarial gains and losses relate to changes in the present value of the defined benefit obligation resulting from experience adjustments and changes in actuarial assumptions. Pension plan interest refers to changes during the period in the net defined benefit or asset that arises simply from the passage of time. In accounting for a defined benefit pension plan, actuarial assumptions include financial assumptions, mortality assumptions, assumptions about the discount rate to be applied, assumptions about expected future salaries and benefits, and also medical cost assumptions. IAS 19 uses the projected unit credit method to account for defined benefit pension plans. This method assumes that each period of service by an employee gives rise to an additional unit of future benefit, and these units build up to the overall eventual obligation. The treatment for a defined benefit pension plan under IAS 19 states that a liability should be recognized when the employee has provided a service in exchange for benefits to be received by the employee in the future. It also states that an expense should be recognized when the entity enjoys the benefits from the service provided by an employee. The entity is required to recognize the net defined benefit liability or perhaps asset in its statement of financial position. In terms of measurement of this liability or asset, the fair value of any plan asset is deducted from the present value of the defined benefit obligation in determining the net deficit or surplus to be recognized on the statement of financial position. Where there is a net surplus, the amount of this surplus is limited by what's referred to as the asset ceiling. The asset ceiling is the present value of any economic benefits available in the forms of refunds from the plan or reductions in future contributions to the plan. Any net defined benefit asset is reduced to the asset ceiling threshold, and any write-down is treated as a remeasurement and it's recognized in other comprehensive income. This table summarizes the P&L treatment of defined benefit contributions. We see that service costs are recognized in P&L. Also, net interest is recognized in P&L, whereas any remeasurements of the net defined benefit or liability or asset, which can relate to actuarial gains and losses, return on plan assets, or some changes, as we mentioned, in the effect of the asset ceiling, these are recognized in other comprehensive income. IAS 19 requires disclosures in relation to an explanation of the characteristics and risks, identification and explanation of the amounts arising in the financial statements, and also how the plans may affect the amount, timing, and uncertainty of the entity's future cash flows. Thank you for watching this short tutorial from the MicroLearning Institute in relation to IAS 19 Employee Benefits.